Ah, yes, let's now stream. Let's now begin NBFC audit. Yeah, I started the live stream. So now we'll begin NBFC audit discussion. And I hope in the previous sessions like 800 series, 700 series, all that I hope you are very confident with. Okay, so now let's enter into the topic NBFC audit. And you know very well there were a lot of amendments in NBFC audit chapter. And even in the recent MTP1 also, one practical question has been asked in the May 2025 MTP1 series 1. A practical question has been asked regarding capital requirement adequacy ratio computation. Don't worry, we'll be working on that. Okay, now, so audit of NBFC. What is audit of NBFC? So first of all, what is an NBFC? You know, an entity becomes NBFC based on what activity they do. First point, there is something called principal business criteria. Any entity you take, any organization you take, what are their financial assets identified? Very simple. In NBFC, take their balance sheet. So in NBFC, the balance sheet is presented in the order of liquidity: financial assets, non-financial assets. Like that they present. What is the total of financial assets identified? What is the total assets identified? If the financial assets is more than total assets by 50%, I mean if the financial assets are more than 50% of total assets, and income from financial assets is more than 50% of the total income, if these two conditions are satisfied by any NBFC, naturally it will become by any entity. If these two conditions are satisfied by any entity, we will call this as NBFC. This criteria is called as principal business criteria, or criteria to qualify whether an entity is an NBFC or not. More than 50% of the total assets are financial assets, more than 50% of the gross income is from financial assets. And further, any enterprise, my dear, any enterprise it doesn't matter whether it's an LLB, it doesn't matter whether it's a partnership firm, it doesn't matter whether it's a private company, public company, it doesn't matter. Any enterprise which is satisfying this criteria, they must register as a first company under Companies Act. Then they should immediately apply for RBI for registration. As per 45 IA, every NBFC must obtain certificate of registration from RBI, provided their minimum net owned funds are 25 lakhs, which is a law limit. Again, immediately, don't confuse. Sir, I know. Minimum net owned funds are 2 crore, and for certain NBFCs, the minimum net owned fund is 10 crore. Getting it? I'll come to it. This 25 lakh limit is a statutory limit. Under 45 IA Act limit is still 25 lakhs only. But later with RBI notifications, the limit has been increased to earlier. The limit has been increased to 2 crore for certain NBFCs, whereas for remaining all other NBFCs, 10 crore is the limit. Actually, original notification actually talks about 10 crore limit for only few categories of NBFCs like Facto, microfinance institution, investment credit company, like that. But in our ICAI material, no specific discrimination is given. Right now, directly any NBFC which is applying for registration, any NBFC which is applying freshly for registration, they must have a minimum net owned funds of 10 crore. That's the basic condition. Only if an NBFC satisfies 10 crore net owned fund criteria, right now RBI will give registration. Further, I told, right, 2 crore net owned fund criteria is there for certain NBFCs. Which NBFC is? NBFC peer-to-peer, NBFC's account aggregator, NBFC with no public funds or customer interface. If at all there is an NBFC which does not have any public access, which does not have any public funds access or customer interface, and it's a peer-to-peer lending platform, account aggregator. Wait. I know. You have little confusion right now. Sir, directly net owned funds we are discussing. What is it? Net owned funds alone first we will discuss, then we talk about various exemptions on an NBFC and classifications of NBFC. Then once again you get back and see the revision of NBFC for revision of this particular NOF. Whereas for NBFC IFC and NBFC IDF, actually please space here, NBFC IDF, the net owned funds requirement is 300 crore. Very simple. What is the net owned fund requirement for NBFC? For NBFCs which are freshly applying, 10 crore. For NBFCs which are peer-to-peer account aggregator, NBFC not having public funds access or not having customer interface, the amount of net owned funds required is 2 crore. That's it. And you know what? First of all, What are various types of NBFCs? RBI classified NBFCs into basically two types: deposit taking NBFC, non-deposit taking NBFC. Once upon a time, these NBFCs are again, see, right now NBFC classification is based on the scale of business they do. There is something called scale based regulations released by RBI. Based on the scale of business NBFCs do, right now NBFCs are broadly classified into four categories: base layer, middle layer, upper layer, top layer. Now, top layer is something which is always empty. Top layer is always empty. RBI only will have to keep. Guys, right now there are 9,000 plus registered NBFCs with RBI. Right now, as per the latest RBI, you just open list of NBFCs with RBI, you will get an RBI link PDF. You just open 9,000 plus NBFCs were there. And there are many types of NBFCs. What are they? Investment credit company. An NBFC can do infrastructure finance. An NBFC can do core investment activity. Further, regarding core investment company, there are some exemptions and all available. I will come back to it later. NBFCs are broadly classified into four categories: base layer, middle layer, upper layer, and top layer. Basically, top layer is empty, and upper layer, top 10 NBFCs are by default comes under upper layer. Top 10 NBFCs by default they come under upper layer. Now the discussion is, sir, which NBFC comes in which layer? Base layer, which NBFCs will come? Upper layer, which NBFCs will come? If at all you are clear on these two elements, you are done. You are done with classification. Many students often confuse on classification of NBFCs between layer. You don't have to study. Are your 4 layers are there? No, 2 layers only you have to study. Upper layer by default, top 10 NBFCs by asset size. Top 10 NBFCs in India by asset size, they straight away come in upper layer. Top layer, 0. No NBFC is there right now in top layer. RBI will select an NBFC from upper layer to top layer if at all risk is very high in a particular NBFC. Right now, until date, RBI has not selected any NBFC in top layer. So technically, top layer, upper layer is nothing much to discuss. Now the discussion is between base layer and middle layer. Which NBFCs will come under base layer? Which NBFCs will come under middle layer? Straight away. First middle layer you see. Sir, the NBFC is accepting deposits. Straight away middle layer. Is the NBFC accepting deposits? Yes. Straight away middle layer. No question about it. No sir, it is not accepting deposits. Then it's a non-deposit taking NBFC. Okay. What is its asset size? It's 1,000 crore and above. The asset size of the NBFC is 1,000 crore and above. Then also that NBFC straight away comes under middle layer. Straight away comes under middle layer. So, and a deposit taking NBFC, a non-deposit taking NBFC with asset size 1,000 crore and above, straight away middle layer. Sir, it's a non-deposit taking NBFC, sir. In such a case, asset size is less than 1,000 crore, then straight away it will come under base layer. This is the primary rule. But there are certain NBFCs which are activity based. NBFCs which are carrying out specific activity. Like, you see, right now, what is the classification between base layer, upper layer? What we understood right now, asset size 1,000 crore and above, less than 1,000 crore, deposit taking, and non-deposit with 1,000 crore and above asset size by straight away middle layer. Less than 1,000 crore asset size, non-deposit taking NBFC, we straight away classify under base layer. That is normally. However, for certain NBFCs, they are always base layer. What are they? NBFC peer-to-peer. Their asset size doesn't matter. NBFC account aggregator. Asset size doesn't matter. Non-operative financial holding company. Sir, what is a non-operative financial holding company? There is a difference between core investment company, non-operative financial holding company. In India, there are only 3 non-operative financial holding company. One company is Bandhan Holdings. There is a company called Bandhan. You know Bandhan Bank, right? Yeah. Bandhan Holdings, there is a company that's a non-operative financial holding company. Core investment company is also an investment company. Non-operative financial holding company is also an investment company. But non-operative financial holding company, they are permitted to invest. They are permitted to invest only in financial sector like banks and NBFCs. They can only invest in financial sectors, banks and NBFCs. Whereas core investment company, for example, Tata Sons Private Limited is a core investment company. They can invest in any enterprise. They can invest in any enterprise. When do we call a particular company as a core investment company? Minimum 90% of their total assets. Minimum 90% of their total assets are represented by investments. If investments occupy minimum 90% of the total assets, we straight away call it as what? Core investment company. Fine. So that's core investment company versus non-operative financial holding company. Often many students do not have clarity on this. Peer-to-peer means what? Very simple. It's like an Amazon app where lender will register, borrower will register. Both of them will register. Lender will post about loan options. Borrower will post about loan requirement. Borrower credit assessment, everything will be done by the NBFC peer-to-peer. Lender will credit to the borrower. Accordingly, he'll get the income. Peer-to-peer is a platform. Account aggregator is one such platform where entire your information will be available at one place. Your information will be given access to banks and all by these NBFCs. NBFCs without public funds, NBFCs without customer interface. These NBFCs always come under base layer. Then there are 5 categories of NBFCs. NBFC, deposit taking, a core investment company, infrastructure finance company, standard primary dealer, and standalone primary dealer, housing finance companies. These 5 categories of NBFCs straight away will come under middle layer. Their asset size we don't see. These 5 NBFCs will straight away come under middle layer. Now what about remaining NBFCs? Remaining NBFCs, I will see deposit taking or non-deposit taking. Deposit taking middle layer, non-deposit taking asset size 1000 crore and above middle layer. Non-deposit taking asset size less than 1000 crore base layer. Over. That's it. Over. This entire classification is over. As simple as such. If you have a doubt, once again read. That's why here once again that activity based is explained. Top 10 NBFCs by asset size come under upper layer. Top layer is basically empty. RBI will bring any NBFC in upper layer to top layer if at all there is a significant increase, substantial increase in systematical risk. That's it. Classification of NBFC is over. Further, most important, government owned NBFCs, they always come in either base layer or middle layer. Sir, government owned NBFCs, sir, asset size is so big. Still, they will never be placed in upper layer. Government owned NBFCs, they always come under base layer or middle layer. And further, once upon a time, NBFCs are referred as with various classification. NBFC, deposit taking, systematically, NBFC, deposit taking. NBFC, non-deposit taking, systematically important. NBFC, non-deposit taking, non-systematically important. Once upon a time, NBFC rules, how an NBFC will be categorized, just a minute. Just 1 minute. Once upon a time, NBFCs are broadly classified into 2 categories. Deposit taking NBFC, non-deposit taking NBFC. The non-deposit taking NBFCs are again classified into 2 types. Systematically important, non-systematically important. What is the criteria for systematically important, non-systematically important? Asset size 500 crore. If the asset size is 500 crore and above, they're all systematically important NBFCs. If the asset size is less than 500 crore, they're non-systematically important NBFC. Whereas right now, how NBFCs are classified based on asset size of 1000 crore. Getting it? Now, earlier, RBI has given so many notifications. What notifications? NBFC, Reserve Bank, non-deposit taking, systematically important, deposit taking guidelines or regulations. Same way, NBFC, Reserve Bank, deposit taking regulations, directions. Actually, they're called as directions. Okay, directions. NBFC auditors report directions, like that multiple directions and all were there in our book once upon a time. Now they removed all that. Now what department is what RBI is saying? Dear deposit taking NBFCs, non-deposit taking systematically important NBFCs, now onwards please call them as middle layer or upper layer as the case may be. Whereas once upon a time we have non-deposit taking, non-systematically important NBFCs, right? Now onwards call them as base layer. They are simply telling earlier we call non-systematically important, non-deposit, now call them as base layer. Getting it? Deposit taking, non-deposit systematically important, call them as middle layer. Simple. Even look at, just 1 minute. Even, sir, there is an NBFC, sir, which is systematically important, but asset size is less than 1000 crores, sir. Between 500 to 1000. Why, Once upon a time, systematically important, non-systematically important, what is the criteria? 500 crore. Now base layer means what? Less than 1000 crore is a base layer. What about there is an NBFC which is actually as per old time systematically important, but now it is 750 crore. Yes or no? Now here you are saying what? Systematically important NBFCs are called as either middle layer or base layer. But what about an NBFC which is systematically important having 750 crore asset size? Even then still be called as middle layer, upper layer, because the asset size is 750? No. If the asset size is less than 1000, then you please call them as base layer only. Simple. Right now, whether an NBFC is a deposit taking or non-deposit, deposit taking, straight away middle layer, upper layer. Non-deposit taking, asset size less than 1000 crore, systematically, non-systematically, doesn't matter, base layer. Asset size is more than 1000 crore, straight away will classify it as middle layer. That's it. Listen once again, you will get more clarity what I told. And you know what? Net owned funds requirement I told, right? What is the net owned fund requirement for NBFCs right now? 2 crore. For newly going to incorporate NBFCs, what is the net owned fund requirement? 10 crore. By the way, you know, there are some NBFCs where current net owned funds requirement is like the RBI has given three NBFCs related specific detail. 3 NBFCs. You know, these 3 NBFCs, if at all they are applying for registration now, 10 crore is a direct net owned fund requirement right now. Sir, these are already registered, sir. Right now they are having 2 crore net owned fund, 5 crore net owned fund, you know, and for example, investment credit company, micro financial institution, and factor. Right now, earlier they have, this is the net owned fund requirement, sir. Now by 31st March 2025, please increase it to accordingly. This is called gliding path. This actually called as a gliding path. By 31st March 2027, whether you are a factor, micro financial institution, investment credit company, you must have a net owned funds of 10 crore. That's it. With this net owned fund requirement, classification of NBFC is completed. One of the major chunk is completed. What is the difference between NBFC and a bank? NBFC is also doing financial activity. Bank is also financial activity, but banks can accept demand deposits. NBFC cannot accept demand deposits. So NBFC cannot accept demand deposits, but can accept term deposits. NBFCs, no, they cannot have a payment and settlement system and cannot issue checks drawn on itself. For example, when I open a bank account in a bank, I will be given a checkbook. If I deposit in a bank, suppose with NBFC, I have some term deposit, I have some fixed deposit. Okay, can they give checkbook to me? No, they can't, because NBFC cannot do payment and settlement. That's it. And you know, with the banks, you know, I don't know how many of you know this. If you have a bank balance in a bank, your deposit is protected up to 5 lakh rupee. If at all bank became insolvent, you know, there is a credit guarantee corporation, you know, deposit insurance credit guarantee corporation, you know, that insurance is there. Deposit insurance credit guarantee corporation, up to 5 lakhs insurance is there in case of banks. This facility is not available to NBFC. That is the reason why NBFCs offer higher rate of interest, because risk is high with NBFCs. And you know what? Banks and all has to lend minimum to priority sectors some amount. NBFCs are not required to lend to priority sectors like, you know, banks and all. There is no minimum requirement to lend to priority sector. All that clear. Next, now most important part of the discussion, capital requirement. This has an amendment, very big amendment. You know, whether it's a bank or NBFC, all of them has to maintain something called capital requirement adequacy ratio. Every bank and NBFC, even insurance companies, you know, insurance company, for your information, they must have minimum 100 crore capital in order to start insurance business. NBFCs must have net owned fund is one criteria. In addition to the net owned fund, the capital requirement for an NBFC shall also be 15% of risk weighted assets. Risk weighted assets, for your information, I am classifying it as RWA. So every NBFC must maintain a minimum capital ratio of 15% of the risk weighted asset RWA. Minimum, that's the minimum capital requirement. Very simple. Let me give you one diagram here, okay, where you can understand that particular thing. Okay, please make a note, ma. This PDF cannot be given to you because it's difficult for me to maintain entire this, all that you know, exporting everything. So I'm just scribbling randomly. Don't ask for this PDF. Kindly please make a note if at all you find something valuable. Pause the video and make a note of it in your book itself. Right now, what is the capital requirement adequacy ratio? Remember, they may tell you capital requirement ratio or capital requirement adequacy ratio, whatever it is. What is the capital requirement ratio for NBFC? 15%. If you remember bank audit chapter, it is 9%. For banks, it is 9%. 15% of risk weighted assets. Sir, what is risk weighted assets? Very simple. Risk weighted asset is nothing but risk weight multiplied by asset items. Okay, they will give some risk weights. We will see the list of the risk weights. Asset values will be there. You multiply that, you will get risk weighted assets value. On that value, multiply with 15%. You will get what is the capital required. And you know what? In financial sector, capital is broadly classified into two tiers, tier 1 and tier 2 capital. Tier 1 capital is called as high quality capital. Tier 2 capital is not a high quality capital. And you know, within this 15% of risk weighted asset, tier 1 capital can be up to 10% of risk weighted assets only. Nothing but out of 15, 10 means what? 2/3. Minimum 2/3 of the 15% of risk weighted assets. Indirectly, that is expressed as 10% of risk weighted assets. That should be tier 1. Balancing figure can be tier 2. Whereas gold based, if an NBFC is lending against gold jewelry, they must have a tier 1 capital of 12% of risk weighted assets. This is the minimum requirement. Now, what is tier 1 capital? What is tier 2 capital? Now, look at this. Tier 1 capital means what? Tier 1 capital means owned funds. Tier 1 capital includes owned funds reduced by, from own funds value they'll give you, reduced by investment in other NBFCs and group companies. Investment in other NBFCs, you might have, this NBFC might have made investments in other NBFCs and group companies, right? Don't reduce full investment straight away. Identify investment in excess of 10% of the own funds. Very simple. What to do? Suppose in exam they'll give you a problem. What you need to do? Just a minute. What you need to do? For example, you know, owned funds are there. For example, owned funds are 1000 crore. Investment in subsidiary and other NBFCs is equal to 250 crore they made. Now, how much you should reduce? 250. Wrong. That's wrong. You should reduce only 150. You should reduce only 150. Sir, how come, sir? You reduced by investment, they said, right? No. Reduced by investments in investment in subsidiary and other NBFCs in excess of 10% of own funds. 250 crore invested minus 10% of own fund is how much? Own fund is 1000 into 10%, 100 is equal to 150. In exam, they will give you investment made in subsidiaries 250 crore. They just like that they gave 250. Then you should identify 250 minus 10% of own funds, balance. Sometimes in exam, they'll give you straight away 150 crore value, nothing but investment in subsidiaries or investment in subsidiaries and other NBFCs, which is in excess of 10% of net owned funds. Therefore, tier 1 capital, how much? 850 crore. Remember, not only this, tier 1 capital also includes perpetual debt instrument. Tier 1 capital also includes what? Perpetual debt instruments. Perpetual debt means perpetual. We will not redeem it at all. Perpetual debt instruments can be there as a part of tier 1 capital. And how much can be as part of tier 1 capital? Suppose NBFC issued some perpetual debt. NBFC issued some perpetual debt. That perpetual debt will be classified into tier 1 and tier 2 both. Perpetual debt will be classified into both tier 1 and tier 2. How much of the perpetual debt comes in tier 1? You know, perpetual debt issued by non-deposit taking NBFC up to 15% of the aggregate of tier 1 capital, whatever the capital amount as on 31st March of the last year, is there, right? Last year tier 1 capital information you will have. On that 15% you apply up to that amount. In this year, perpetual debt can be there as a part of tier 1 capital. For example, you know, last year, just a minute. Last year, you know, previous year, last year, tier 1 capital is 1000 crore. Okay, right now we have 250 crore perpetual debt. Now, out of 250 crore perpetual, tier 1 how much? Tier 2 perpetual debt how much? This is the question. Tier 1 perpetual debt can be up to 15% of tier 1 capital of last year. Last year capital is 1000 crore into 15% is equal to 150 crore. Sir, but total perpetual debt is 250. No, excess perpetual debt is classified as tier 2 capital, where 100 crores will come as tier 2. You see here. What is tier 2 capital? You see here. Excess perpetual debt beyond tier 1 limit, that you will classify as a tier 2 capital. Further, a base layer NBFC cannot have perpetual debt in tier 2 capital. Here also, a base layer NBFC cannot have perpetual debt in tier 2 capital. Base layer should not have a perpetual debt. Further, what is a tier 2 capital? So which means tier 1 capital means two things: owned funds minus investments in excess of 10% of the owned funds in subsidiary, reduce, plus tier 1, perpetual debt to the extent to the extent of 15% of the tier 1 capital of the last year. You will get tier 1 capital total. Tier 2, preference share capital which is non-convertible. Revaluation reserve discounted at 55%. Actually discounted at means what, you know, revaluation reserve will give you value in the problem. You will have to multiply it with 45. Wait, sir, MTP 55 they did. Wait, I'll tell you. So revaluation reserve into 45% is equal to some value you will get. That value is part of tier 2. 45 discounted at 55 means, tell me, 100 rupees discounted at 10% means 90 rupees, right? Which means 100 minus 10 you do. Same way, if revaluation reserve is 100, discounted at 55 means 100 minus 55 is equal to 45. This is right approach. But MTP1 contains a wrong answer, where they consider revaluation reserve discounted at 55, right? They multiplied it and they took some value as multiplication, which is actually wrong. Okay. Now in exam, what should we write, sir? You write MTP answer only. In an alternative, within bracket you put alternative. Discounted at 55 means 55% shall be reduced, 45%. Accordingly, tier 2 capital will change. Like that you put. Then general provisions and loss reserves, including provision created for standard assets. I don't know how many of you know this. NBFC's loans and advances. No. See, basically NBFC gives loans and advances. These loans and advances are broadly classified into standard, substandard, substandard, doubtful and loss assets. So standard assets also NBFCs have to maintain some provision, some 0.5% or 0.25%, like that, some provision they need to maintain. Okay, so including the provision for standard asset, general provisions all put together, they will be treated as tier 2 capital. Technically provision is a amount set aside. So technically it is also something like a cushion capital. It is also called as a cushion capital. How much? Max 1.25%. Suppose, you know, the company in the problem they said provision amount so and so amount. You will not take full amount of provision under tier 2. You will only take up to 1.25% of risk weighted assets. By the way, those of you who got my printed book, in that this particular point, this particular risk weighted asset 1.25% point, and this excess of 10% owned funds point, these 2 points actually I skipped that time intentionally, but later since MTP1 gave a problem, we considered and added it back again in the PDF. And I already made a video why we skipped intentionally earlier and why we added it now. I already made a video regarding corrections, one video almost 3-4 days, 5 days ago itself I made a video. That's it. So this point, those of you who are wondering how come in my printed book it is not there, if at all GoTo Notes you're watching it is not there, just these 2 points you please add. Okay. If you're having any doubt, just to go to our website, Sreshta for CSMA, free resources. Inside that, select CA final, GoTo Notes category you take. Corrigendum I already gave. Just download that corrigendum, you will understand. Able to understand. That's it. Now, or else you're watching this video, right? There is a playlist, QR resources playlist. On the top, you will find that rectification. You just watch that and rectify. Then hybrid capital instruments. That is also tier 2 capital. Subordinate debt is also called as tier 2. And remember, total tier 2 capital can never exceed tier 1. If at all tier 2 capital is more than tier 1, capital requirement ratio is not satisfied. Now, let's solve one MCQ. Sorry, let's solve one MTP question straight away. Straight away we'll start one MTP answer, MTP question. Yes, you see here. So this is the MTP question. Okay, in this we have one practical question on this capital requirement testing. This capital requirement testing only we have some practical question. You see here, this is the practical question 4A in NBFC 4A. There is a company called Q Limited, which is an NBFC classified under scale based regulation framework. It is required to maintain a minimum capital ratio of 15% of the risk weighted assets. Okay, the company has provided following information of tier 1 tier 2 capital. Owned funds, 1000 crore. Very simple, directly let us apply owned funds in our calculation. Let us apply our calculation. Okay, owned funds, how much is the owned funds? 1000 crore. Okay, next, investment in shares of other NBFCs and group companies. Investments in shares of other NBFCs exceeding 10%. Oh, after crossing 10% only 150. We can straight away reduce this 150. 850 is tier 1 capital, not full capital. It's part of tier 1. Next, perpetual debt instrument issued by total. Oh, total perpetual debt is 120. Within this, tier 1 how much, tier 2 how much, we need to find out. Perpetual debt up to 15% perpetual debt up to 15% of last year tier 1 capital can be part of current year tier 1 capital, right? We will see last year tier 1 capital information. They have not given last year tier 1 capital information. So I will take an assumption this entire 120 crore, I will take an assumption that this entire 120 crore will be part of tier 1 capital only. This entire 120 crore will be taken as part of tier 1 capital only. So 120 tier 1, total tier 1 capital is 970. We'll see, is there any other tier 1? I think these two only. Tier 1 capital is 970. Now preference shares which are not convertible, obviously non-convertible preference shares are how much? Tier 2 capital. So tier 2 capital is equal to 80. Again, revaluation reserve. Remember, revaluation reserve you need to discount at what rate? 45%. How much is the revaluation? I mean 55% is a discount rate. So 200, actually in the answer they gave 55%, which is actually wrong. The right answer is 45. Discounted at 55 means only 45 you should consider. But let us calculate as per 55 logic only. 110. Then general provisions and loss reserve. 50 crore is there, which is general provision, but you can't take full amount. You can take general provisions and all. How much? 1.25% of risk weighted assets. How to calculate risk weighted? Don't worry, in exam 99% they will give you risk weighted assets. 8,000 into 1.25%. So generally 1% is equal to 80 crore. 1.25% means 100 crore. Yeah, correct. 100 crore. So only 100 crore general reserve I will consider. Then general provision and reserve I will consider 100. Oh, sorry. Only 50 is given. Up to 100 we can consider. Since it is only 50, I will consider only 50. Then hybrid capital instrument 90. Subordinate debt 140. That's it. So therefore total capital is how much? 190, 240, 330, 330 plus 40, 370, 470 crore is there. Which means total tier 1 capital and tier 2 capital how much? Let us do one thing. Total tier 1 and tier 2 how much? Tier 1 970, tier 2 470 is equal to 1300, 140, 1440. That's it. Now whether capital requirement ratio is satisfied. Minimum how much will be required? 1440. You see how to calculate ratio. Total capital fund how much? 1440 divided by risk weighted assets how much? 8,000 into 100 is equal to what is the percentage that you are getting? Approximately 18% you will get. Approximately how much you will get? 18%. That's it. That's the answer. Okay, you see the answer in the NBFC. So they did almost in the similar way. So first they calculated tier 1 capital, then tier 2 capital, then they calculated how much. Here actually in NBFC, no, this point is wrong, ma. The answer which ICAI gave, no, they multiplied with 55. It's actually 45. Please remember, it's actually 45. Write an alternative answer if at all the same question comes in. See, ultimate May exams. Getting it? Now here you see again they did one more wrong. Here you see capital adequacy 1440, right? They took only 1400. I told right. ICAI book contains so many mistakes. Okay, that's it. So finally our answer is 18%, which is correct. That's it. Whereas minimum capital ratio is only 15. So 18% is maintained. Yes or no? That's it. And moreover, within this 8,000 crore into 10% must be risk weighted assets. 800 crore must be tier 1, right? Our tier 1 is 970. So the 10% criteria is also satisfied. That's it. That's it. So with this capital requirement adequacy ratio, one more important provision is also completed. Now what is a risk weighted asset concept? I told you balance sheet assets and liabilities values will be given. Assets values will be given multiplied with risk weight. This risk weight you apply. Okay, in this, no, I request you to remember these risk weights. Consumer credit loans other than consumer credit loans, which is categorized as a retail loan. All retail loans given by NBFC except housing loan, education loan, jewelry loan, microfinance and self-help group loans. Except them, remaining all other loans, risk weight is 125. Credit cards, risk weight is 125. Indirectly, all unsecured loans, risk weight is 125. Okay, whereas fixed assets, complete risk weight is 100. Whereas government guaranteed advances, central government risk weight 0. State government loan we gave. State government gave a guarantee and loan we gave. There is no default at all. 20 only risk weight. Already default started more than 90 days over. Risk weight is 100. Or default started but default is less than 90 days. Risk weight is 20. These risk weights alone you remember. Maybe an MCQ might come on this. That's it. Now finally, just 1 minute. Now, now let us understand income recognition asset classification norms. Every NBFC shall recognize their income on accrual basis only. However, for non-performing assets, income is recognized on cash basis. For non-performing assets alone, income is recognized on cash basis. Cash basis means what? Only when the amount is actually collected, it will be recognized. Further, an NBFC, every month, banks and NBFCs, every month they recognize on accrual. What is NPA norm generally in banks? 90 days is the NPA norm. You might have learned in CA intro also. Suppose, I am recognizing interest every month on accrual, but actually customer is not paying EMI. But until 90 days, I can't classify it as NPA, right? So up to next 3 months, I am recognizing on accrual. After 4th month started, customer did not pay even now the first month EMI. Yes or no? More than 90 days crossed, EMI did not pay, interest he did not pay, 90 days crossed. Now the asset became NPA. But what about already recognized interest income? 3 months I recognized on accrual. And there is one rule, right? Income on NPA is recognized only on actual realization, right? But I already recognized on accrual basis before it became NPA, but I didn't collect anything. Now it became NPA, right? You recognized income, right, on accrual, right? Reverse that income. Further, remember, every NBFC shall classify whatever the loans they have given into 2 categories. Standard asset is 1 category. Remaining categories are called as NPAs. NPA means what? NPA is again subclassified into 3 categories: substandard, doubtful, loss. Getting it? Now you know what? Once an asset is going into NPA, can I upgrade it to standard asset again? Only if it satisfies conditions for upgradation. Every NBFC and RBI has given upgradation rules. Only if a particular loan satisfies that upgradation rules, asset can be upgraded. Otherwise, it cannot be upgraded. Now, what is an what is a standard asset? What is a substandard? What is a doubtful? What is a loss asset? But first, before I discuss substandard, all that, first standard asset means what? No default is there. No default at all. No problem or risk is there than a normal business risk. There is no risk, no problem, and there is no default in repayment of principal or interest or both. That's a standard asset. When an asset becomes NPA, an asset is considered as NPA if it remains overdue. If it remains overdue for more than 180 days. Just 1 minute. An NBFC is considered as, a particular advance given by NBFC is considered as NPA if the interest is remaining overdue for more than 180. In case of term loan, installment is overdue for more than 180. In case of demand or call loan given by the NBFC to another NBFC, overdue is more than 180. Interest on short term loan or advances more than 180. Due from sale of assets, NBFC sold some assets. Okay, from that amount is not yet received. Overdue period is more than 180. NPA. Any credit facilities, bills purchased and discounted, overdue for more than 180. NPA. Lease rentals, hire purchase entities, NPA directly more than 180 days. And remember, every NBFC has to classify. Every NBFC, by the way, here, this F point, more attention. By the way, I skipped this one of the point. Now let me tell you. You might have heard one point. NPA classification is borrower wise, not loan wise. Suppose I am a Muthoot Finance or I am a Bajaj Finance. You borrowed one housing loan from me. You also borrowed one personal loan. You also borrowed car loan. Car loan EMI you did not pay. More than 180 days crossed, overdue. By the way, this 180 days limit is revised to 90 days. That discussion also I will tell you. There is a gliding path on that. I will come back to it later. Okay, now. Just a minute. Yes, just 1 minute. Yeah. Yes. Yeah. So you might have seen. So if one car loan became NPA, automatically remaining 2 loans also we will classify it as an NPA. That is what this F point. Any credit facilities became NPA when any other credit facilities become NPA when any of the above credit facilities have an outstanding overdue of more than 180. If above facilities have, means above 5 facilities are there, right? Above 5 facilities are there, right? If any of the above 5 facilities become NPA, then any other credit facilities of the same borrower will also become NPA. That's it. And remember, this 180 days norm is there, right? Now for all NBFCs, by 31st March 2026, they need to classify based on 180 norms to 90 days norm. Now I remember overnight if RBI implement this, many NBFCs balance sheet and all will badly affect. So what they did, they gave a gliding path. By 31st March 2024, implement it to 150 days. By 31st March 2025, which is already, which is already completed, 120 days. So which means for 24-25 year NBFCs, they should classify whether an asset is NP or not based on 120 days norm. For next year, 31st March 2025, they need to classify based on 90 days norm. If you see, capital gliding path is there, net own difference gliding path. There, originally the RBI has given guidelines on 31st March 2023, 31st March 2025, 2027, 2 years gap is there for NOF, capital glide. Whereas for NPA classification, the time gap is 1 year, 1 year. Exactly. So that's how you can easily remember. Okay. The gliding path, some students they asked me, sir, how to remember, sir, different dates and all were there, how to remember? Very simple. For NPA classification gliding path, 1 year only they have given relaxation. Whereas for NOF, suddenly how come you bring that much of loan? Suddenly own funds, 2 years gap they gave. So 31st March 2023, that time guidelines were released. By 2025, you need to increase it to 5 or 7 crore. By 2027, you need to increase it to 10. That gliding path for microfinance institution factors and ICC infrastructure credit company. Whereas for NPA classification purpose, 180 days norm, please reduce it to 150 days for 31st March 2024, reduce it to 120 by 31st March 2025, reduce it to 90 days by 31st March 2026. That's it. And next, remember, there are already some existing NBFCs before the scale based regulation. Earlier, this NBFC norm is applicable based on systematically important and non-systematically important. Systematically important, deposit taking, non-deposit taking NBFCs, 90 days. Remaining NBFCs, 180 days. So what are all NBFCs which are already following 90 days? For them, no change. They always have to follow 90 only. Next. Now, okay, NPA it became, sir. Now, once it became NPA, straight away a loan which is NPA will be classified as a substandard. An asset which is NPA up to 18 months, it is straight away called as what? Substandard. For middle layer NBFCs, it is not 18 months criteria. Next 12 months, once it became NPA, up to 12 months it is part of, up to 12 months it is substandard. Up to 12 months. And further, there are some other loans which are also treated as substandard. A loan or asset whose terms were renegotiated, rescheduled. Then next 1 year till satisfactory performance, next 1 year of satisfactory performance, until 1 year we'll put on observation. Next 1 year they're following and complying with rescheduled terms properly. Then we will classify it as standard asset. But for next 1 year we will classify it as a substandard asset. So substandard asset, two assets. A loan which became NPA up to 18 months base layer substandard, and up to 12 months for middle layer substandard. Whereas rescheduled loans up to 1 year of satisfactory performance substandard. Then doubtful asset. What is a doubtful asset? If at all substandard 18-12 also completed, now it is entering into 19th month or 13th month from substandard category, straight away we classify it as a doubtful. Then loss asset. This is something a bank has to manually do. The internal auditors, external auditors, RBI or the bank, if they identify some doubtful asset as a loss asset, they will classify from doubtful asset to loss asset. Now why we need to learn this asset classification? Because the NBFC has to maintain a provision. They need to maintain a provision. For loss assets, if you want to keep the asset in the books of accounts, trade receivable or loan amount you want to show, then create 100% provision. Sir, I don't want to keep, sir. Anyhow, it's a loss. Write off. Either keep 100% provision or write off. Suppose if it is a doubtful asset, first I will come back for standard asset. Sir, it's a standard asset, sir. No NPA, no default at all. Still, for standard assets, create a provision of 0.25% of outstanding amount. Whereas for NBFCs which are part of, which are other than upper layer, they said. So for upper layer, what is the regulation applicable? In our syllabus, it is not there. For upper layer, what is the regulation applicable? In our syllabus, it is not there. Just 1 minute. Yeah. So NBFCs, the provision of standard assets, how much? 0.4%. NBFC, for middle layer and all, the provision is 0.4. For base layer NBFC, 0.25%. And remember, generally when a provision is created on NPA, the provision is netted off. Total loan how much minus provision how much, balance how much we will show. But standard asset provision we should not net off. We will show it under liability side. How we will show it under liability side? Contingent provision against standard asset. This can be asked as an MCQ. Be careful. That's it. Then, and remember, now what is the provision for substandard category? Straight away 10%. In case of banks, it is 15%. For NBFC substandard asset, straight away 10. What about doubtful asset? Unsecured portion, 100%. Secured portion, first 1 year in the doubtful category 20%, next 1 to 3 year 30%, more than 3 year 50%. Remember, this is the total amount of provision. It is not each year this much provision. By the time D1, D2, DT, we call them as what? D1, D2, D3. If the asset is in D1 category, total provision on that asset must be 20. If the asset is in D2 category, on that loan, total provision till date must be 30% of the outstanding. If the asset is in DT category, total provision must be 50, which means from substandard 10, right? If at all it is going to D1, we will add another 10 so that 20% will come. Suppose if it is going to D2, D1 to D3, I mean D2 category, for example, then we will add another 10, we will make it 30. Suppose if it is going to D3 category, we will add another 20, we will make it 50. Suppose if it is going to loss asset, we will add another 50, total provision will come 100%. It's an incremental approach. It's not straight away 20 plus 30 plus 50. No, it's actually 10 plus 10, 20 plus 10, 30 plus 20, 50. From here to loss asset, it will be plus 50 directly 100. That's how the provision has to be calculated. Remember, in our question bank, we have given certain questions in NBFC audit. You can make use of that question bank and solve it. Next. Finally, almost major part is over. Audit procedure part, I'll come back to it later. In that, only key points I will discuss. Not every point I'll cover, only key points I'll cover. NBFCs and banks will have some frauds. Banks and NBFCs have to report regarding details of fraud to RBI. In a year, there will be so many frauds. When the NBFC is reporting to fraud, when the NBFC is reporting fraud related data to RBI, they need to classify what type of fraud it is. For the purpose of classification of types of frauds, the frauds are broadly categorized into following. Type number 1, misappropriation and criminal breach of trust. Fraud through forged instruments, that is another type of fraud. Unauthorized loans given to some customer, that is another type of fraud. And cheating and forgery, another type of fraud. Irregularities, foreign exchange, and any other type of fraud. Even this fraud reporting applicable for foreign branches of Indian NBFCs. Further, negligence and cash shortage. Negligence means there is no intention, unintentionally something happened, that is also classified as fraud. Cash shortage means sometimes cash shortage will happen, nobody has stealed it, sometimes accounts will not tally, cash shortage is there, or some temporary something accountant forgot to record some payment. This cash shortage also you will record it as fraud. Yes, you will treat it as fraud if intention is proved. If the intention is proved. However, if the cash shortage is more than 10,000, intention doesn't matter. Straight away treated as fraud. The following cash shortages are always frauds. If the cash shortage is more than 10,000, always a fraud. Sir, cash shortage more than 5,000, sir. But cashier did not report that. Management auditor, inspection officer detected this. Then also we classify it as a fraud. General rule is what? Cash shortage is not a fraud unless intention is proved. However, more than 10,000, pakka fraud only. Intention there or not, we don't see. More than 5,000, but cashier did not identify this. Manager identified this. Management identified. Auditor identified. Then also it is treated as fraud. That's it. Classification of fraud is completed. Next. Now, in this, there is something called audit procedure. What is the audit procedure for NBFCs? In your ICAI book, there is a TYK question. There is a test your knowledge question given for peer-to-peer. Peer-to-peer. In our MTP also we have given peer-to-peer. For example, I'll just show you. P2P. Yes, there is one question here we have given. You see, in ICAI book they have given something called test your knowledge. Test your knowledge. NBFC peer-to-peer, test your knowledge of in a test your knowledge question in ICAI book. This is actually we have given in our question bank. So for peer-to-peer, what you will understand in the business, this is separately given as an additional topic in test your. Please read this without a failure. Okay, that is most important. From here until the end of the chapter, I will only cover important points. So steps in NBFC is what? First, understand the business of the NBFC, whether principal business activity and all satisfied or not. Look at the internal control system of the NBFC. Just one minute. Verify registration with RBI, whether NBFC has a minimum net owned funds of 10 crore or not. See whether they got a proper registration certificate or not. Check it out. Next. And you know what, NBFC which is accepting public deposits. What is the audit procedure for NBFC which is accepting public deposits? What is the audit procedure for NBFC accepting? This itself straight away will come for 4 or 5 marks question possibility. Many students neglect this. Please remember. You know what auditor has to verify? You know an NBFC can accept public deposit only when there is a credit rating. Only then when there is a credit rating from approved credit rating agency. Accordingly, there is a limit on the deposit to be accepted. So check whether deposit limits are as per the credit rating. Interest and brokerage calculated correctly. Maintenance of deposit register. In every NBFC which is accepting deposit, even in companies and companies, 73 to 76 section, every company has to maintain deposit register. And see that every, you see Nidhi company has to maintain 10% unencumbered term deposit in, yes or no? What is that? Nidhi company has to maintain liquid assets. Bank has to maintain SLR, CRR. NBFCs have to maintain liquid assets. So they need to invest in approved liquid assets. Getting it? And they need to timely file returns with RBI regarding liquid assets, regarding all the deposits, all that. And further, in case credit rating, most important, this is asked many times in exam. Okay, in case credit rating is upgraded or downgraded, deposits will be adjusted, especially when the credit rating is downgraded. Credit rating will become B, B++, A plus, like that ratings will be given. Accordingly, limit of deposit, how much you can take, will be given. Suppose a higher rating is there, you accepted higher deposit. Now the rating has been reduced, you should refund to the deposit holders. You should adjust them within the time frame. Sometimes in MCQ they'll ask you, if there is a downgrading in the deposit, auditor has to check whether the deposits are adjusted within the time frame. That's it. However, there is one more point. There is a minimum investment grade. There is a minimum rating requirement to accept deposit. First of all, suppose if the credit rating is downgraded below investment grade, then it is not just adjustment. Severe consequence. Stop accepting deposit. Do not renew. Whatever existing deposits are there, right? Run till maturity. Report to RBI within 15 working days of downgrading below minimum investment grade, and don't renew without depositor's consent. That's it. So this is directly, they can directly ask you this. Then one more thing the auditor has to verify is prudential norms. Income recognition, whether income is recognized on accrual, on NPA only cash basis or not, asset classification, standard, substandard, and provisioning for bad and doubtful debts, capital adequacy, all that. And all that, very easy. Okay, next, just 1 minute. I hope you're all enjoying. Yes. So that's it. Next, audit checklist. What is the audit checklist for NBFCs? This audit checklist example is given from the point of view of ICC, NBFC Infrastructure Credit Company. From that point of view, audit checklist is given. Now, what is this? What is the audit procedure? Okay, in audit checklist, for ICC point of view, first almost few points they have given from investments point of view, whereas from here, like 13th point of view onwards until the end, investment credit company. This is investment credit company, means first they will be investing and they will also give loan. From investment they get interest, from loans they'll get interest. So this is a company, business is like that, investment credit company. So for investment credit company, what they will do, they will get from investments dividends and bonds. In exam they might ask you only this point, write about investment in investment credit company, audit of dividend and interest income, your general accounting principles only. This itself can be asked as a 3 marks or 4 marks question. Please be careful. Further deposits, service loans are given. So very simple, whether this investment credit company, are they giving loan only after proper sanction, whether security is verified or not, whether balance confirmation and all you can get. If at all bill discounting is there, discounting charges are correctly accounted or not, you check. Banks and NBFCs, they will have something called maximum limit. They will have something called how much maximum to a particular borrower can be given a loan, or in a particular entity, how much I can invest or how much I can give it as a loan. There is a limit. See whether that limit is satisfied or not. Further, one point, if at all an NBFC is investing in debentures and bonds which are unlisted, it is treated as term loan. Important for MCQ. Okay, and next, that's it. So loan classification and provisioning and all proper or not for ICC general. This is not a much complicated point which you can see on your own. Most important, already important aspects we completed. Another important point is reporting by audit. This is one point where many students don't understand. Reporting requirements, audit reporting requirements for NBFCs. In this straight away I will come and tell you. First to know, here what is audit reporting requirement? Auditor has to give a report to Board of Directors as well as Reserve Bank of India. What auditor has to give to Reserve Bank of India? You see, I will first discuss about Reserve Bank of India. Okay. Obligations of auditor to submit an exception report to RBI. Obligation of the auditor. This actually miscellaneous points we said. These 2 points are actually relating to reporting to Board of Directors. Okay, these 2 points are actually relating to Board of Directors, but miscellaneous points, not that greatly important. That's the reason we kept it last. But this third point, reporting to RBI, most important. This report is also called as something called exception report. This report is called as something called exception report. What is this report is talking about? If at all auditor identified that one NBFC has not complied with the provisions of NBFC law. Chapter 3B provisions of RBI Act is nothing but NBFC provisions. If auditor identified non-compliances with the provisions of RBI Act, or if auditor has identified NBFC's acceptance of public deposit directions, if auditor identified that an NBFC has not complied with NBFC acceptance of deposit rules, actually it is not complied with the RBI Act, not complied with NBFC deposit directions, NBFC scale based regulations, 3 set of rules, RBI Act, deposit taking directions, scale based regulations. If these 3 were not complied, so you need to check non-compliances with all these 3. You need to check non-compliances with all these 3. Then auditor shall report the details of that non-compliances to RBI. Remember, you should only mention to RBI contraventions. You should not include regarding any compliances and all. That's it. This is report to RBI. And further, generally you need to give a report to Board of Directors. Especially if the NBFC is not accepting deposits. What you need to give a report to Board of Directors which is not accepting deposits? What report you should give? Generally, if an NBFC decided not to accept deposits, they first have to pass a board resolution that they will not accept. Verify whether board resolution is passed for non-acceptance of deposits. And see really, have they accepted deposits? Check out. And every NBFC has to comply with prudential norms, rate, asset classification, income recognition. Check that and see that the NBFC is maintaining capital adequacy ratio. This is a non-deposit taking NBFC. See net owned funds and capital adequacy ratio. Are they maintaining or not? Are they complying with minimum capital ratio? And they need to submit an annual statement of capital funds and risk assets and exposure, risk asset ratio and all to the RBI within certain time limits. See whether they are maintaining capital asset ratio. See whether they are maintaining capital requirement ratio and whether they are filing the forms with RBI or not. And if at all NBFC is classified as microfinance institution, check out as per master direction. Is the NBFC liable to be classified as a microfinancial? See whether it is classified correctly or not. So in exam they'll ask you, write about reporting by auditor to Board of Directors. Reporting by auditor to Board of Directors in case of NBFCs which are not accepting public deposits. Sir, NBFC is accepting public deposits, sir. What auditor has to verify? Remember, already we have seen audit procedure point, we have seen accepting public deposit, liquid assets statements, exactly same points will be there. Auditor has to check various criterias and report to Board of Directors about compliances and non-compliances. Simple. Finally, by the way, this reporting to RBI, Board of Directors and all, you need to report, right? Where it is told, RBI has given one directions called FOSR directions. Remember, this is important for MCQ. Filing of supervisory returns directions 2024. RBI has given filing of supervisory returns directions 2024. As per that direction, as per these directions, there are some matters. For every NBFC, you need to report what matters: whether certificate of registration is valid or not, principal business criteria satisfied or not, in case whether are they eligible to hold certificate of registration, are they still satisfying or not, see whether NBFC meet net owned funds requirement, and most importantly, statutory auditor certificate they need to obtain. NBFCs must obtain a statutory auditor certificate. NBFCs must obtain statutory audit certificate and file it with the RBI. What is the statutory audit certificate should contain? Yes, the company is engaged in NBFC activity and the company is eligible to hold certificate of registration. Like this, they need to give a confirmation. Auditor has to give a confirmation. I need to give a certificate. I need to give a certificate. Yes, the NBFC is actively involved in principal business. They have a valid registration certificate. Like that, I should give a statutory audit certificate. The SCAC, this certificate must be submitted to RBI regional office within 5 working days of signing the audit report. Once auditor signs the audit report, right, of the NBFC, within 5 days, SCAC certificate has to be submitted to RBI regional office. But not later than 31st December. After audit report is signed, within 5 days send it, but maximum within 31st December you should send it to RBI. And the format of statutory auditor certificate regarding NBFC, getting it, that is given by directions 2024. That directions you follow. That's it. And finally, Caro, I already told. Caro already told. It is. I told you. Please refer CA Inter. Inside that, I clearly told. There is a clause number 3 in CARO regarding investments and guarantees. Inside the totally 6 subclauses were there. Subclause A, subclause E, they do not apply to NBFC. I clearly discussed in CARO point where I told refer my CA Inter marathon. I already told in reporting chapter. In the reporting timestamp you will find. Then clause number 16 in CARO. This also I hope you are already aware of it. This is not a big deal. Next, finally, what about accounting standards applicability? Every NBFC, they have to comply with Ind AS. They have to comply. They have to prepare financial statements in compliance with the Ind AS. Yes or no? And further, in Ind AS, there are 2 divisions. Actually 3. Division 1, Division 2, Division 3. What is the difference between Division 2 and Division 3? The differences are very simple. Mostly they both are same, but the following exceptions they have. What are they? NBFCs can present the items of balance sheets in order of their liquidity. Disclosure of other income and expenditure. NBFCs can disclose other income and other expenditure exceeding 1% of the total income. Whereas for Division 2, 1% of revenue 10 lakhs. 2 criteria were given, whichever is higher. And disclosure of debts due from LLPs. If there is any LLP in which a director is having, is a partner or a director. I mean, if NBFC director is a partner in one LLP, if at all we need to receive any amount from that LLP, that should be shown separately under receivables. Further, most important point. If at all there is any receivable by the NBFC and if there is a high risk in that, it should be separately disclosed. And most importantly, NBFCs can present the balance sheet and all in order of their liquidity, financial assets and non-financial assets. That's how they present. Generally in balance sheet, normally non-current assets and current assets. Here it is financial assets and non-financial assets. Then I think in this, there is no much complication, technically speaking. And finally, statutory reserves and all they need to maintain. They need to separately disclose in notes about statutory reserves and conditions attached, all that. So these are some minor differences between Division 2 and Division 3. Actually, many of these divisions are not really valid technically in reality. That's it. With this, NBFC audit is completed. Just 1 hour, 3 minutes hardly. 1 hour hardly. And see the kind of clarity you got right now. I hope you all thoroughly enjoyed this NBFC discussion. Okay, I'll be happy if you leave comments below. That's it. So take care. Continue the next session. Okay, we'll continue the next session after some time.